These are really expert people who've made a career out of and are very competitive in doing the very best job they can possibly do at gathering information and putting it into play. So we have a market that's gone from being very inefficient and lots of opportunity to do better than the market to being very efficient in finding the right price and making it virtually impossible for anybody to do better. Good example of that is if you look at mutual funds, about 85% of them fall short of their chosen objective over a 20-year period. If you do a little bit of adjusting for taxes, that 85% runs up to closer to 95%. And there's no known way to figure out who were the 5% that actually did better, and they don't do very much better, whereas those that do worse do a great deal worse. So the idea of active management has come under fire, rightly so, and there are a whole bunch of different reasons. One, when I was first in the business in the early 60s, a proud slide rule would be your principal device. Now everybody has computing power greater than an IBM 360 sitting in their pocket. The internet hadn't been developed. It's now everywhere. Mike Bloomberg was still in college. Now he's got terminals all over the world, hundreds of them, telling anybody anything that they would like to know at any time. Research, there was none at Merrill Lynch. Goldman Sachs was putting out a 4-page form in very informally to some of their clients, but nothing very well organized. There was no other research available anywhere. Now it's all over the place. Everybody has access to an extraordinary amount of factual information from very, very talented people who are working with the data that's available. It used to be, back in the early 60s, that you would go to lunch with a corporate executive who was trying to be sure his stock was fairly priced so he wouldn't be subject to a corporate raider coming in and grabbing off his company. Because he wanted to have it fairly priced, he would talk to you if you'd done a really good job of homework, and you could have a very good, useful, insight-generating conversation that would give you a really important competitive advantage. Well, today, of course, that's against the law. With Regulation FD for fair disclosure, the SEC does not allow any publicly owned company to give information to any one investor that they don't make a conscientious effort to get to every investor. So now what we do is quarterly 800 number calls, and there'd be hundreds of people on the call if it's an exciting company. Then this information is therefore everywhere. So while you might individually think, God, I've got great information. Boy, have I got great computing power. Boy, do I have a wonderful organizational staff working with me. Don't I have all kinds of big advantages? And the answer would be yes, but so does everybody else, and they all have it at exactly the same time. So the reality is that the old ways of doing things just can't work and should be put aside as wonderful antiques from a long ago past, and you ought to concentrate on what can you do now. And the answer is there's some very important things that you can do. One is indexing makes everything easy. And indexing helps you with low cost, I grant that. Helps you with low taxes, I grant that. More importantly, by a long shot, indexing is boring. And therefore, you don't make the mistakes that behavioral economists love to show us that we make mistakes all the time. The average investor loses in an average year almost 2% of the assets involved. 2% out of 20 or 30% may not be all that bad, but 2% out of forecasts that I hear from friends who are really smart, somewhere between 6 and 7% to the future, that 2% is a big whack. And if you said, wait a minute, take inflation out, start with, let's say, 7%, take 3% of inflation out, you're down to 4%, then take 2% for behavioral economics, you're down to 2%. That's a really tough squeeze. What can you do about it? The answer is easy. The answer is index and stay with it. The second thing is emphasize equities very strongly for the long term. If you're saving to buy a home or saving to send your kids to college, put that into bonds because you need to have that money when the bill comes due. But if you're saving for your own retirement, you're talking about 30, 40, 50, maybe even 60 years between now and when you're going to actually spend the money. And that's the time frame that really counts. And if you've got that much time, the obvious way to be an investor is to do equity investing at the lowest possible cost. And instead of attacking the challenge by trying to beat the market, turn around and attack it. Minimize fees, minimize behavioral economics mistakes, and you'll have a higher rate of return to compound over the long term. And that higher return compounding really, really matters. So is there ever time for bonds? Yeah, on specific circumstances. But for the long-term investments, all equities makes a great deal more sense. There'll be turbulent times. There'll be times when the market tells you, you are completely wrong. This is a terrible thing to be doing. But over the long term, that turns out to be fluctuation around the trend, and the trend is very much in your favor.